Are you an agent struggling to understand real estate economics? Would you benefit from learning how top agents structure their businesses? Then you've come to the right place. And welcome to another edition of the Nerdy Agent Podcast, where we teach you the basic economic and business principles that you need to thrive in today's real estate market. AJ, you were off by about 5 seconds.
I did the first you.
You're on a little bit early. I'm your host, Luke Pettersen, with my brothers and fellow nerds, Josh and AJ. What's going on, guys?
It feels weird to be recording in the afternoon after playing golf with you guys today in a different spot, too. There's a lot of change going on here.
It's a bummer that Dad had to sink that putt on the 17th to get you guys.
It's a big hit. Dads always win. That's usually the message here.
Yeah, we tied and then lost the tiebreak that made us tie again, and then lost that tiebreak due to age as well. There's a lot of losing for our team today.
Super clear explanation.
So much winning over here.
Moving into the Would You Rather of the week, Josh came up with a good one this week. Would you rather have your house heated with a boiler, which is hot water heat, or a furnace, which is gas heat essentially, but it's air, forced air heat?
Through the house.
Do you want me to answer that question? That's so easy.
Is it?
Boiler, significantly better.
See, Josh?
I will throw out, though, yes, you're right, that a boiler is a much more efficient heat source. The reality is that a lot of houses that are heated with boilers, A, have radiators that are kind of ugly, and B, also tend to have, you have a higher correlation between houses with boilers and houses that don't have air conditioning.
Whoa, I didn't see air conditioning on the question.
I'm just saying, though, if you had to pick a house based on the heat source alone, you have a higher likelihood to get one that doesn't have an air conditioner.
My house,
this is what I said too.
The perfect house, in-floor heat rambler in the basement with a forced air furnace that AC's the main level is the perfect house.
That was the argument I made too. I said, we're specifically talking about heat. Boiler heat is better. However, I don't like how the radiators look, and they take up too much space. But once central air conditioning gets in play, if you have central AC with the boiler heat, which a lot of people actually do, higher priced homes, I mean, it's pretty nice.
I walked through a house the other day and I showed my clients, they would have had no idea what I was looking at. And I showed them there was a register near the floor. It was right outside the door of a bedroom, and it was louvered, so it was obviously a supply, and the return was just right up above it. And I said, well, at least in this room, you'll be comfortable if you stand right here next to both of these. Otherwise,
he's going to be pulling the hot air.
Otherwise, it will be kind of hot or kind of cold.
That's awesome.
That's why I don't like forced air. But it's an unfortunate necessity here in Minnesota.
It looks like we have our first disagreement on the Would You Rather, which was kind of fun this week. Josh likes forced air.
A little bit on the semantic side is where I'm kind of arguing this week. But if you walk through enough houses in St. Paul, Minnesota, or Minneapolis, Minnesota, you find those ones that have the boilers, and you go, whoop, I wonder if this has central AC.
That is the first
half the time it doesn't.
And where is my furniture going to go? Because it doesn't fit around this massive thing.
Boiler. Yep.
Well, let's get into what the people actually want to listen to on this podcast. We're getting into the very nerdy stuff this week. Okay, we're going to be talking about adjustable rate mortgages, but also about yield curves, specifically inverted, what that means because of the current state of our economy, and what that means for mortgage rates and also financing options for your clients. Just to get started, what I want to talk about initially was why agents should care not only to understand, what a yield curve is or what adjustable rate mortgage is, but why they should care to actually follow along and understand what's going on the, in the entire market when it comes to those things.
Yeah, I mean, our entire economy is very tied together. And so the stock market, the bond market, mortgage rates, everything sort of works together. And so it's very important to understand which numbers to be looking at and how those numbers impact different parts of the real estate world, right? So we're talking yield curves. That's going to have a pretty, bond yields, I should say, more simply, has a very direct impact on mortgage rates, depending on which product you're choosing. Knowing what adjustable rate mortgages are doing in those sorts of situations is important. And same thing with buy downs, right? So just knowing how to properly educate your client, not saying you're a lender, but to properly educate your client and then pass them off to a qualified lender, that's going to go even more in depth.
I would say the average real estate agent in the market probably knows roughly where interest rates are, right? So if all of a sudden you understand on top of that, the next level of knowledge about rates and yields and adjustable rate mortgages can kind of give you that leg up as well.
It can make a significant difference for a client too. So they might not be thinking about some of these things, but once they do, they might save 75 basis points on their rate. And that's an option that suddenly is open to them because you asked a question and because you understand when the time is right to potentially consider certain options.
Can I tell a quick story though?
Yep.
I mean, we'll get more in depth.
It'd be funny if Luke just said no.
AJ's story time.
I had a client that was looking at close to a 7% rate. They were going to do a buy now. We're going to talk about this stuff later. But then across the sea, the British government, the Federal Reserve, said, this bond market's out of control. We're trying to fight inflation, but we're just going to give up for now. We're going to start buying bonds again. The entire market responded across the world, and our mortgage rates went down by 0.3 to 0.4%, to the point where my clients, just because of the UK, they're probably saving hundreds of dollars a month now on the home they just got a contract on. So pretty wild.
I think, and it's important to note, I think that when we're in a market where things are uncertain, it becomes more of an opportunity for agents to actually make a difference for their clients. You can actually help them. You're not just opening a door and hoping they pay enough money to win in multiple offers. Mm-hmm. You can do things and be knowledgeable to help them in that situation.
It's more important to be good too when the sales are down and there's fewer buyers and sellers out there, right?
Exactly.
So we see 30% drops in pending sales. So only the best agents are going to do well and survive in those markets.
What more can you do to be the best agent in the market? And so to get us started, we're going to start with the yield side of things. So just bare bones, super basic, what is an inverted yield curve?
Yeah, and I'll be very honest, I don't think this is something that every agent needs to have memorized. So a lot of the stuff we talk about here, we're saying like this should be something you know that you might not know today, so really pay attention. Inverted yield curves are a pretty complex deal, and even how they happen and what they mean exactly, I'm not going to go into that much detail. But at a high level, it's essentially saying that the short-term bonds in our marketplace are paying higher than the long-term bonds. So right now, maybe this when we were looking at the numbers, it's like 4.2 roughly for the 2-year Treasury bond, 10 years paying 3.8% interest, and 30 years paying 3.7%. So what that means is that if you bought one of those, you put $10,000 out, your return on each of those bonds at any given time is tied to that number. So you'd get a 4.2% yield if you put a $10,000 out for 2 years, but then you get all your money back in 2 years. In 30-year money, you're putting your money out for 30 years and it's sitting there and you're constantly getting this return. And you're actually getting a lower return to lend your money for a longer period of time than you are for a shorter period of time right now. The reason that's what an inverted yield curve is the longer term financing or bond market is paying out less than a short term.
And in a standard market, it's normally opposite of that.
Correct. And the inverted yield curve has a high correlation with recessions.
It's predicted, I think, 12 of the last 5.
12 of the last 5?
12 of the last 5 recessions?
Correct. 12 of the last 5.
I think
do you get it?
You inverted.
No. Do you get it? It's 12 of the last 5. It's inverted 12 times during the last.
We've had 5 recessions.
Within the last 5 recessions.
Oh, yeah. Okay.
It doesn't always lead to a recession.
Got
but
it.
Typically, when we do have a recession, the yield curve
Correct.
does invert about 18 months before we call it a recession.
Exactly. So it's important in the sense that it does have a tendency to correlate with recessions. At the same time, it opens up some potential options for clients, or it changes some things in terms of what the financing market tends to do and how they respond. So that's why it's important.
Yeah, and so when the yield curve inverts, when it becomes an inverted yield curve, what does that typically mean for mortgage rates, and how does that affect that?
Kind of like we talked about. I mean, it means that the investors on the bond market are predicting that the future, long-term future, is better than the short-term future. So more demand equals lower yield. So more demand for the 10-year makes that lower than the demand that's currently in play for the 2-year. So everyone is expecting that things are going to get better in the future, but they're going to be bad in the near term, basically.
And right now what we've seen is the spreads between the 10-year interest rate and the actual 30-year fixed mortgage financing are higher than they've really been at historical levels. So we tend to see, 1.5 points?
Well, during quantitative easing, which was when, not to get too into the weeds, but when the Federal Reserve was actually buying these bonds, mortgage-backed securities, things like that, we saw that yield drop to about 1.5%. I think it was like 2012, 2013 to like 2019, 2020. I think in 2019, they actually was when they signaled they were going to stop buying. That's when we saw that big spike in rates back then.
Yep.
But yeah, they were running like 1.3 to 1.6 through that whole period. And they're now at
it's over 3.
3.2, 3.1.
Yep.
So yeah, the prediction is that, the overnight rate goes up, the yield on the 10-year goes up, and that 30 years, I don't know, going to continue to go up until there's some certainty in what's going to happen in the future.
Yep.
We would almost think that if the people on the back end had uncertainty for the short term, that if we were in an even market, that the long term they would rather be investing in, which would drive the 30-year down.
Say that again, Luke.
So, and I know this market is a little bit weird, but theoretically what you're saying is if there's less demand for the short term because they're worried about the market, there should be more demand for the long term.
That's what's driving this. So as more bond money is funneling in, they're picking the
there's
long term
more,
because
but there's you got to also realize on the bond market there are sellers and there are buyers, right? There's currently more sellers than buyers. One big reason why is because the Fed in 2019 signaled we're no longer buyers, we're now sellers. We're rolling all this off our balance sheet. So now that's trillions of dollars of sellers just as the Federal Reserve. Right,
I just want to make sure we clarify that because it did kind of sound like if we had more demand for the long term, that rate should be going down, but it's not. It's still going up.
It's still going up,
and that's because we're just kind of completely out of whack in general.
Well, and just they're operating separately, and there's still like you were saying, there's still an outlook that in the future things are going to get better, and that's why this inversion starts to happen.
Sure, that makes sense. And so I want to talk about adjustable rate mortgages and how they differ from the 30, because in specific situations, the adjustable rates make more sense debatably than a 30-year fixed, and in some they don't. So tell us about that.
At a high level, the adjustable rate mortgage is just a financial instrument that is fixed for a period of time that's pre-established. So like we do 525. So when I say 525, what I mean is the rate that we get is fixed for 5 years, but is on a 25-year amortization schedule. So a typical 30-year mortgage is fixed and is on a 30-year amortization schedule, whereas ours keeps that 25-year amortization schedule, but after 5 years, that rate essentially balloons and resets.
Yeah, we have a balloon payment technically, but our lender says pretty much we'll just relock you at the going rate.
Exactly. But a typical, on the residential side adjustable rate mortgage, it's just going to change. The interest rate's going to change after that set period.
5, 7, 10, and there's terms, it will change once per year. Some of them are like, we've heard like 7, 6, where it changes every 6 months thereafter. And it can only move by a certain amount. So if you have a client that's considering these, just make sure that you're talking to them about what the real terms are within their mortgage, because this is not quite as simple and straightforward as a 30.
I think the 3, well, there's kind of 4, but I think the 3 are going to be when it adjusts the first time, how often it can adjust after that, and then the max it can adjust per adjustment.
And the max that it can go up to, I think,
total over the life of it would be what you'd want to ask the lender if your client is looking at those. And why would, because in some markets it does make sense. It was a short period of time, I believe, that they made sense here during this change in the economy. But when would adjustable rate mortgage theoretically make sense over a 30 year?
Well, I think what we were seeing is as the environment was changing, there was still some capital on behalf of a lot of the banks, whether they be local or national around here, and they were trying to capture business during that time. They were trying to put more loans out to get them on their balance sheets. They saw those rates. They felt like they were historically pretty good, but they didn't want to fix that paper for 30 years. They were happy to do it for 5 to 7. There still are out there right now portfolio products on construction loans. I have a doctor doing a loan at $1.5 million at 4.5 that locked in when the interest rates were 6. 4.5% interest on a 1.5 single borrower that's a doctor is still pretty attractive. These people are making decisions not based on the box that I commonly talk about that Fannie and Freddie have. They're making decisions based on their board, the banker that's doing the loan, and things like that. So they might be more likely to say this one couple that makes X amount of dollars is pretty good for returning us our money, and we like that rate historically, especially over, let's just say, the next 7 years, 10 years, I think maybe even that one was, because they're locked into that loan. So they like it and they like the borrower, so they'll maybe do it. That said, when it starts to try get into the period where you're trying to fit it into the box, as the short-term yields start to be super, super high, you start to see the spread on, let's say, a 5-1 or a 7-1 arm and a 30-year fix get smaller and smaller.
And theoretically, you should, if you're getting an adjustable rate mortgage, part of the reason is that your initial rate is going to be a decent amount lower than a 30-year fix at that time, because you're saving money on the front end for the risk of it adjusting in the future.
Exactly.
And so if the rates were the same, you'd always pick the 30-year because you're fixed for a longer period of time. And
so let's say in a normal market, right, yield curve isn't inverted. There's typically you're looking for an adjustable rate mortgage to be a good enough below the 30-year fixed. What happens when the yield curve inverts for ARMs and the rates?
So in that scenario, typically, now as AJ mentioned, I think it's two things to call out. One is there's this component of discretion that exists within ARMs that doesn't exist quite the same way within fixed mortgages. So because banks can make decisions to try to help support their strategic vision, they can you still have some situations where you'll find decent deals during some of these periods. So part of why the adjustable rates are important to talk about right now is rates are really, really high. And so anytime rates are really, really high, it's important for clients to be as thoughtful as possible about how they go about evaluating different products. But historically, when yield curves invert, what that says is the short-term money is essentially less attractive for the bank than the long-term money is. And so in that case, the spread that we're talking about between a 30-year fixed and an ARM is going to get smaller and smaller and smaller.
It's closer together.
To the point where or it could even flip on it.
Sure.
But to your point about the kind of confusing question you had before,
Yeah.
everything is kind of crappy for the lenders right now. When there's uncertainty, they don't want. There's a point where they don't want any paper, so they need to keep making these loans happen. But that's why you're seeing these spreads get, like the 10-year and the 30-year fixed, spread out so much.
Yep.
Because they don't even want to originate those at what a normal historical rate would be, because they don't know what's going to happen next.
So what you're saying is before our yield curve inverted, essentially it made sense for a little bit for the buyers because the 30-year fixed went up a lot and the adjustable rate mortgages were still at a price where you could get a lower interest rate up front and fix it for 7, 5 years, whatever that was.
Yeah, because a lot of the bankers were looking at it and saying, we
This
think the
still
rates
makes
are going to
sense.
come back down, so we're comfortable taking a lower rate in the short term
This
if we can
still
keep
makes
them for
sense
5 to
for
7 years. Yep.
But when the yield curve inverted, all of a sudden that spread was too close together where right now it might not even make sense for buyers to get adjustable rate mortgages, right? So they're kind of stuck on that 30-year fixed timeline.
It's not a terrible idea to evaluate, to my point earlier about discretion, but
Sure.
you're going to likely see ARMs be less competitive in an inverted
And
environment.
they make a ton of sense on portfolio products and weird loans, construction and stuff like that.
Exactly. And so theoretically, just assuming that's not going to be an option right now, let's just say based on the current environment, we talked about buy downs a lot. So I want to know like what does this environment mean for buy downs and what are the other options buyers have to get better terms?
Yeah, so I mean, I talked about, and again, we're not mortgage lenders, guys. We're not going to tell you that we're going to be able to originate loans. We don't do that. We just tend to want to know a lot about these sorts of things, and so we use that knowledge to tee up the buyer before they go to their lender. And again, when I'm doing this, most of the time I'm working with a lender that I'm already talking to on like a daily basis, and they're giving me the intro into it so that I'm having that conversation maybe at a showing with a buyer and saying, hey, one thing we could think about in structuring our offer is asking the seller to cover X amount of closing costs, even though we don't necessarily need them, because we could put that towards buying down your rate.
So I just want to interject super quick. If you don't have a lender that you can talk to on a daily basis that can update you about what's going on. I mean, we talk about having lenders that will keep you up to date with what's going on, keep you knowledgeable from a financing perspective so you can give your buyers something at a first showing or something at a first meeting. Right now, more than ever, you need to be in touch with your lenders and know what's going on because otherwise you're going to get incorrect information to your clients and that's going to set really bad expectations and create some not great outcomes in my opinion. And so I just want to jut in, make sure everybody knows that's really important. But you were talking about the buy downs with closing costs. Just what are the options?
The two options right now that we have been talking about with clients are straight buy downs. So that would be paying points is what it's called. And what we've seen is roughly 0.75% to 1% off your interest rate in exchange for 2% of your mortgage upfront. So if you're originating a $400,000 loan, if your buyer's getting a $400,000 loan, $8,000 was making your rate be about 0.75 to 1% lower than the going rate.
And from just for a term knowledge there, 1 point is 1% of the purchase price.
1% of one point is 1% of the purchase price. The point that you use is actually only going to be part of the mortgage balance. So when you get 2 points in closing costs, it's actually more than 2 points of the mortgage.
Got it.
So you can use that towards your closing costs if there's some spread there, if you're 20% down or whatever. But that's a straight buy down, right? That is attractive in today's environment because it reduces your payment. And like we've said, we don't know where prices are going. And so the big thing that everybody's saying is like, we're just going to refinance. It's no big deal. Well, if you have a low down payment right now and prices slip 5% even over the next 2 years, you can't just refinance without bringing another 5% to that deal. So that's something that I think everybody should be keeping in mind because I know there's a lot of agents loosely just being like,
just refi.
Just take the rate and refi, or just buy it down and then refi later, or whatever. Like you want to think about every situation so that your client is comfortable with their payment no matter what happens in the future, right? So that's one of them that we're talking about. The other one is what we call a 2-1 buy down. So that's typically the lowest payment for the first 12 months, a more medium payment for the 12 to 24 month period, and then for 24 months until 360 months, it goes back to the going rate. The reason why I like this one a lot is because the majority of borrowers, I'd say maybe 75, 80%, I don't know what the real number is, we can figure that out, are W-2 earners. And so they're not just going to get, a raise of 20% like a business owner could potentially have, but they're typically getting 3 to 5% every single year. most of my friends, when I talk to them, this is what they say. And that number could eat up that spread as we go through the years.
So make sure we explain the spread. So you said the lowest option. What is the low?
My client is getting 2% in closing costs.
Yep.
Okay, from the seller. That 2% is going to buy the rate down about 2% for the first 12 months. So for easy numbers, let's say 675 is the going rate. They're going to pay 4.75% for the first 12 months, 5.75% for the next 12 months, and they'll be at 6.75% for years 3 through 30. Now, this is attractive because in many situations right now, and again, talk to your lender about this and get the options out there, but in many situations, that buy down is going to be paid back in about the first year.
Mm-hmm.
So I'll repeat
Financially.
that. I'll repeat that. Like in my situation, $16,000 the seller's paying, my buyer is going to recoup all of that on the difference between the going rate and the first year rate that they have. So that's what's telling you the investors are thinking it's going to get better. And that's back to the earlier conversation we had. They think it's
very
getting
first
better.
podcast we talked about this.
Well, yeah, and we're saying in the future, they think rates are coming down because typically in a recession, the overnight rate starts to come down and the mortgage rates follow. And so if you can capture all that money up front, get your buyer into a price point where they wanted to be when the rates were better, by getting them a 2% maybe lower interest rate the first 12 months, it might be a super attractive option for them.
And I think, sorry.
I was just saying something that we've talked about buyers a lot right now, but we've also talked about this on the sell side because listings are tending to sit a little bit longer now because the market's not as competitive. And so you can offer some of these things as a seller with your listing, as a listing agent for your seller, to try to get more buyers in the table. Say, hey, we're going to offer $8,000 towards a buy down for the buyer of this house, or something along those lines.
The reason that's a really good point, actually, and happy you brought it up, because it's important to note, and our lenders are saying that the 2-1 buy down option can only be seller financed, is what they're telling us. And so that's a really important note. If you're the listing agent calling, someone schedules a showing, there's other houses in the area that might be similar, and you call them and said, we're going to get you a 2-1 buy down. So instead of being at 7, you're at 5 for the first year. And all of a sudden they tell the buyers that, and they didn't know that. That might be the difference between selling the house and not selling the house.
Now I'm viewing house 1 and house 2 very differently in terms of what the impact
And again,
is.
and the whole point of this podcast was to get to this very situation, right? And if you're a seller, you're maybe not having, you're a listing agent, you're maybe not having these very real interest rate conversations. But if you know about this, because either you listen to our podcast or you're just paying attention, you're talking to lenders, you're going to be able
nerdy agent.
You're going to be able to offer this though to your seller, and it might sell a house that otherwise maybe wouldn't have sold.
And when that happens, they're going to tell all their friends about how cool your ideas are.
You can actually add value. And I wanted to also make sure that I just pointed out one more time too, that when you said the 2-1 buy down option, the first reason you brought it up from an advantageous point for your clients was because of the possibility of getting a raise, not instantly saying you can just refi in 2 years. Because I know that this will happen to people. Well, they will tell their clients this, and in 2 years, they won't be able to.
Yep.
And they'll be like, why the HE double hockey sticks, did you tell me that?
We
don't swear on this podcast. I can't do this anymore, right? Or the prices slipped, which we're going to talk about next week if you want to know where we think prices will be going on the podcast. But that's important to note.
Yeah, absolutely, I think.
So we're going to get out of the nerdiness into what everybody is telling us is their favorite part of the podcast, the weekly script from AJ. And this week, we're going to be talking about you're with your friends, and someone...
Hold on.
Yep.
Where are we?
Where are we? We're golfing.
We're just
golfing
with
today.
our friends.
We're golfing.
Okay,
we're
so
on the
it's
golf
casual.
course. We're not driving carts. We're push karting, so we can talk while we all walk down the fairway.
We all hit it down the fairway.
We all hit it right down the middle of the fairway. We're all next to each other.
Par 5.
And someone mentions that their lender is starting to talk about adjustable rate mortgages and explain this to them. How can you be the expert in adjustable rate mortgages, but then also inverted yield curves to kind of go over the top?
Yeah, I think, mostly right now, what I'm mostly focusing on is just the 10-year treasury yield. I know the inverted yield curve is something that sounds sexy and people want to talk about. That would, it indicates a recession, like Josh mentioned earlier. And that's what everybody says. Well, we're in a recession, whatever. Maybe we are, maybe we aren't. We're going to know when the guys get together in the room a little bit later.
In the room where it happened.
So I would say you need to understand how the yields work and what it's signaling. Do you understand how the mortgage industry works?
So you would start and say, do you understand how the mortgage industry works?
Yeah, I would say, do you understand how the mortgage industry works?
No, I don't.
Most people have no idea, right? They say, well, your lender's going to originate a loan, and then he or she's going to sell it off to another lender, and then down the line, it's going to get backed by Fannie or Freddie if it's a conventional loan. and it's going to have to fit into this box. Well, all of the investors that are potentially investing in that bond are signaling things all of the time, right? They're signaling what they think is going to happen in the future. And if right now I can call my lender and he says, you can get a 2-1 buy down, and in the first year it'll pay back the entire cost of the thing, I'm starting to ask the question of, what does that mean that the investors are signaling?
Mm-hmm.
And if you can dumb it down for people like that, what does that mean? People are going to say, well, it seems like they think that things are probably going to get better in the 12 to 36 month time horizon, right? And so then you can start talking to people about how that impacts things. But I think at the end of the day, what you need to encourage people if they are buying a home is what makes the most sense for them, what makes them comfortable, and like Josh said, give them as many options as possible.
So not just talking about adjustable rate mortgages, but talking about what that means for the entire market in general.
Yeah, exactly.
Other options you might have.
I don't think we've done any ARMs other than the stuff that's outside the box right now. On the conventional options, I still think right now the most conversations we're having are about this buy down because I think it can get people a similar house that they were tied to before. Buying a home is so emotional, and I think getting them the rate that makes the most sense while also understanding in year 3 that they've got to be in a comfortable position is very, very important. So I think it's just talking about yields and talking about what the buy down environment is like right now. That's how I would talk to someone about this.
Some of the other things too, if you're talking to people, their state and where they're at in their life is really important. So when rates started rising rapidly, a lot of the questions we'd ask people like, so how long are you planning on living in your house? And I had a lot of people come to me and say, well, I'm going to only be here. This is my first, I'm going to be here 3 to 5 years. I said, well, in that case, you may at least try to understand what the ARM situation looks like. Because if you can save 75 basis points on your rate and you're going to move before that thing is going to get to its full 7-year period, you save all that money the whole time. Yeah. So there's different options for where you're at and how you're approaching this.
And one more question I'm asking people right now too, because for some reason I'm getting a lot of yeses to this question is, would you be interested in being a landlord in the future? When they tell me this is our first house, and I say, would you be interested in being a landlord in the future? And they kind of look around and they're like, we've kind of talked like maybe we'd want to do that. I'd be like, well, I would be all for that. We invest in property and all this. And so then it's like, okay, what are we going to do to ensure that not only does this work for you while you live there, but that potentially it's going to really work well for you when you don't live there anymore.
Yep.
So instead of a 2-1 buy down, you might just be straight buy down that situation because you're in a long-term hold position.
Bingo.
Exactly. Well, that's all we have for you today on the Nerdy Agent Podcast. We will see you next week. Remember, be better.